Well, hello, everyone, and welcome to the Benjamin Z. Miller Investor Networking Group. So nice to see everyone from around the world. We've got a great collection of investors, and today we're going to talk about currency trading. It is such a fun topic, so interesting. We'll talk about how you can do this. But first, I want to show a brief clip. I'm going to speed the speed up about 50% and show about a 3, 4, 5 minute clip here of the most famous currency trade in the history of currency trading, the 1992 George Soros trade. It's actually quite interesting, the history of it. So I'm going to just show this clip and then we'll go through and we'll talk about a lot of the economics and things that are driving currency trading.
George Soros, a man, 1999, Europe had another system to manage its currencies. Back in 1979, the countries of the European community weren't ready to give up their national currencies just yet, but they did agree to link them all together at a fixed rate, effectively removing the exchange rate fluctuations you usually have to consider when doing business across borders. This new system, known as the Exchange Rate Mechanism, or ERM, sounded good on paper and did make things easier for a lot of people, but it also made the national banks of these countries very vulnerable. You see, people buy currencies every day in vast volumes to fund imports or exports, and these transactions have a significant effect on the actual exchange rate you can get from the market. So once a country becomes a part of the ERM, it had to constantly monitor the markets and intervene if their exchange rate started to deviate too much. If too many people were buying, the national bank would start to sell. And if everyone was selling, it would go into buy. Without going into too much detail, the ERM was flawed because every country is unique. It has to constantly balance interest rates, inflation, and economic growth, which it cannot do if its currency is artificially chained to others. Margaret Thatcher, the Prime Minister of the UK at the time, understood this very well, which is why she opposed it and why Britain wasn't a part of the ERM when it first began. However, as the British economy worsened towards the end of the 1980s, Thatcher's Eurosceptics lost ground to more pro-European members of the Conservative Party. By October 1990, Thatcher's power had diminished so much that Britain joined the ERM despite her opposition, thanks to the political power of John Major, the Chancellor of the Exchequer at the time. Less than a month later, Thatcher had resigned, and Major was selected as Prime Minister, hailing the ERM as his victory.
All my adult life, I've seen British governments driven off their virtuous pursuit of low inflation by market problems or political pressure. I was under no illusions when I took Britain into the exchange rate mechanism. I said at the time that membership was no soft option. The soft option, the devaluers option, the inflationary option, in my judgment, that would be a betrayal of our future at this moment. And I tell you categorically, that is not the government's policy.
But while November 1990 might have been the start of a very successful political career for John Major, it was just the beginning of Britain's economic problems. You see, when the UK joined the ERM, it was already in a recession. Now, when an economy is in a recession, the central bank, in this case the Bank of England, wants to cut interest rates to prop things up. But because of the ERM, it could no longer do that. The British pound was already a very weak currency, with the UK's inflation rate being 3 times higher than Germany's. If the Bank of England cut rates, it would help the British economy, but it would devalue the pound so much that Britain would have to leave the ERM, which of course John Major would never allow. And so, between 1990 and 1992, the British economy suffered. Of course, just keeping interest rates high wasn't enough to maintain the pound's value. And so throughout these 2 years, the Bank of England would frequently go to the market and start buying up pounds by the millions, using up its foreign exchange reserves in the process. Even that didn't really help, though, since the pound continuously weakened during this time, just barely within the limits of the ERM. Pretty much every currency speculator understood that eventually the British pound would have to devalue. But the billion-dollar question was, when would that happen? And the man with the answer was George Soros. He had been running his hedge fund since the 1970s. His specialty was predicting and sometimes forcing the catalysts to big market events. He knew that almost everyone was ready to bet against the British pound if only there was some sort of bad news that could trigger a stampede big enough to overwhelm the Bank of England. Starting in August 1992, Soros and his fund began building a position against the pound, and here's how he did it. He'd go to a big bank or another hedge fund and he'd borrow pounds from them with the promise of repaying them with some interest on top. Then he'd go to the foreign exchange market and he'd sell those pounds to buy German marks instead. The idea being that when the exchange rate drops, he'd be able to buy back those pounds cheaper, earning the difference as a profit. By the end of August, Soros had slowly built up a position equivalent to $1.5 billion against the pound, but the exchange rate had barely moved. He needed some sort of news to really start increasing his position, and luckily for him, on September 16th, the president of the Bundesbank held a seemingly innocent interview that Soros could nevertheless use. The Bundesbank president said that he doesn't rule out that some currencies might come under pressure, which in and of itself is a very vague and unconvincing statement, but Soros decided that it was good enough for him. That same night, while Europe was asleep, Soros called up any international bank or company, or really anyone that had British pounds, and he tried to borrow them with great success. By the time the British woke up, Soros had sold the equivalent of $10 billion worth of pounds on the open market. Unsurprisingly, the Bank of England was in complete chaos. After an emergency meeting with John Major, the Chancellor of the Exchequer began a desperate fight. At 8:40 a.m. on September 17th, he authorized the purchase of £1 billion from the market to no effect. By 9 a.m., he had purchased another £2 billion, at which point he dialed John Major again to request permission to increase the interest rate, which of course, because Britain was in a recession, would be devastating to the economy. Initially, John Major refused because he thought it would be political suicide. But as Soros and the global currency market continued selling pounds, by 11 a.m., Major conceded, and Britain made a surprise announcement that it was increasing its interest rate by 2%, which is a very big increase. By the end of the day, Britain had purchased £27 billion and had increased its interest rate a second time to 15%. But just Soros alone had sold about half as many pounds, and by that point, the entire world was following suit. At 7:30 p.m., the British government accepted defeat with the following news conference.
A unique day in London's financial markets ended with the Chancellor announcing that the pound was being suspended from the ERM, and that the second of two dramatic interest rate rises during the day was after all cancelled.
Today has been an extremely difficult and turbulent day. Massive speculative flows have continued to disrupt the functioning of exchange rate mechanism. As chairman of the Council of European Finance Ministers, I have called a meeting of the Monetary Committee in Brussels urgently tonight to consider how stability can be restored to foreign exchange markets. In the meantime, the government has concluded that Britain's best interests are served by suspending our membership of the exchange rate mechanism.
Over the next few days, as the foreign exchange markets were left to their own devices, the British pound fell by 15% against the German mark and by 25% against the US dollar. Soros and his fund pocketed a nice $1 billion from their trade, while
So that's $1 billion on that trade that was made. Is a pretty remarkable trade. Okay, so now let's go through some of the basics. The easiest way to understand exchange rates, if you're new to this, is to look at what is good for an economy and what is bad for an economy. So if you take any two countries, if good things are happening in one country, that's going to make the value of that currency go higher. If bad things are happening in another country, that's going to make the value of the currency go lower. And that's how you can just, if you're looking at two countries, you can get a sense for the likely direction. So let's imagine a situation here where we are presented with, if the United States interest rate increase and the UK interest rates don't change, which currency will appreciate? So we've got here, for example, the United States interest rate is shown as 5.25. The United Kingdom interest rate's 5. Out of those two countries, if the US interest rate increases, which currency will appreciate? How can you figure that out? Is it going to be that the dollar appreciates, or is it going to be that the British pound appreciates? Well, the increase in the interest rate, if the US interest rate increases, it's going to lead to the US dollar increasing. And basically what happens is when that interest rate goes higher in the United States, it increases the demand for the US dollar, because more investors that have dead money, they have capital, they say, oh, you know, I can get dollars and I can get a higher interest rate. So it increases the demand. Higher interest rates, they attract capital as investors try to take advantage of the returns. But it's not as simple as, oh, high interest rates are that's one factor of many factors that determine the actual exchange rate. But if you isolate it, just looking at that one of many factors, that's how interest rates impact. What about debt levels? What about let's take another example where the United States debt increases, and let's imagine a scenario where the UK debt does not change. So UK debt levels stay exactly the same, but for some reason the US debt level increases. What's going to happen there with the US dollar? What's going to happen with the British pound? So now we have a situation where the US has taken on a lot more debt and the UK has not done that. What would happen? Well, that is going to weaken the US dollar. The British pound is going to appreciate in that example. So there's several things that drive that. Perceived risk. So if you take an extreme example of maybe some country in Africa that's just printing money, that can have a high perceived risk, and that makes that currency go down in value. Of course, actually increasing the supply of money also has an effect. Flight to safety. If two countries if country A and country B, if country A is taking on a lot more debt, that country is becoming riskier as a borrower, and that country as a borrower, by the action of taking on a lot of debt, it has become riskier, and it decreases the demand in the foreign exchange market for that currency. So that causes it to decrease in value relative to country B. So these are things that are important to have an understanding on. Now, what about exports? Let's imagine the situation where the United States all of a sudden starts manufacturing a lot more and produces a lot of goods that people in the UK want. They start producing a good that people in the UK just love, and the people in the UK start purchasing lots of this US good that is now being manufactured. So exports have increased in the United States, and the UK is taking in a lot of these US goods. That has the effect in a situation like that of it makes the US dollar get stronger. The reason that the US dollar gets stronger in that example is in order to buy the US goods, people have to exchange their British pounds for US dollars. So they sell pounds and they buy dollars. And this has the effect of strengthening the dollar. So it increases demand for the demand initially increases for the goods. People want the US goods. But following along with that, in order to buy the US goods, they have to pay with US dollars. So that makes the US dollar appreciate. So these sorts of trade imbalance, if the US is exporting more goods to the United Kingdom than it imports, it's going to create a trade surplus. So when a country has a trade surplus, say, for example, the US has a trade surplus, this creates a strong dollar. All other factors held constant. And the other thing that it does is it also has an impact on investor confidence, where people, when they see a country that is running a trade surplus, it leads them to believe that the country is more attractive. So it drives up the demand for US dollars. Now let's talk about the history of exchange rates. And one of the important things is the Bretton Woods Agreement that happened towards the end of World War II. It was 44 countries, and they all agreed to set exchange rates. And they also agreed that the US dollar would become the world's central currency, and it would be linked to the value of gold. And something very important in 1971 in the United States happened, where they went off of the gold standards. But initially in the Bretton Woods Agreement, the US dollar was tied to gold, and these countries agreed that they would maintain exchange rates within certain things. So if we went back and looked at British pounds back in December of 1945, one British pound would buy approximately 4 American dollars. So the pound was much stronger. Whereas if you went to the 1st of January 2023, the British pound, it has lost so much value. It has lost a tremendous amount of value relative to the US dollar. And now that same one British pound, instead of buying 4 American dollars, that same one British pound only buys $1.20 US. So those investors that are in the United Kingdom, they are in a situation where if they're getting an 8% rate of return in the United Kingdom and they're getting an 8% return in the United States, there can be a massive difference in terms of the real rate of return. So it's important to look at the real rate of return, and along tied in with that real rate of return is the actual exchange rate. So it's important to consider all these things. Now let's talk about what happened in 1971 when the gold standard ended. So in the 1970s in the United States, the Vietnam War, there was a trade deficit, and that put pressure on the US dollar. It made the US dollar want to go lower in value. There was pressure put on it. So there was a flow of US dollars out of the US. But the thing that is interesting is that at that time, the US dollar was tied to gold. And a lot of sharp people, they noticed this and they decided that rather than US dollars, they would redeem for gold at the $35 per ounce price. And there's quite a difference in today's dollars, how much an ounce of gold costs. But they ended this gold standard in 1971, and the increase in price levels was incredible. Look at what happened here. So this is the Consumer Price Index, which shows how much is the rate of inflation, how much are prices rising. So we see here's the United States in the Revolutionary War, the War of 1812, the Civil War, World War I, World War II. Look at what happens in the year 1971 when the gold standard is removed. That is where you get these price levels that go through the roof. And just for fun, we have some costs in the if we were to go back to the 1971, a new house average cost in the US was $25,000. You could buy a new car for $3,560, and the average rent was $150 per month. Gasoline was 40 cents a gallon, and a stamp was only 8 cents. So really had a big impact. So what about forecasting exchange rates? Well, one thing that you also want to look at is you want to look at the rates of inflation in different countries. You can get these from a lot of sources. One source is the IMF World Economic Survey, and you can see here inflation rates. So we can see that the US is at 3.5%. Look at Venezuela. It almost won first place, but Zimbabwe managed to get even higher inflation. It got up to 204%. So, but this is an important thing. And if you look at this, you can kind of get an idea of what's going on. So, okay, floating exchange rate. So when Bretton Woods ended, most of the currencies just floated against each other, but there were some that are fixed. So they still are around, some of these fixed currencies. But let's talk about what makes a currency appreciate. So if you have a situation where there's an expectation about future exchange rates, this can have an impact, just the fact that people expect something to happen. If you look at the country's debt level relative to GDP, gross domestic product, the value of all goods and services produced in a country in a year, if you increase the debt, that will cause the exchange rate to depreciate. So if we look here at Argentina, Uruguay, these countries are experiencing a lot. The balance of trade, we talked about that earlier, where if a country is exporting a lot into the market, if they're selling goods and services to another country, that other country buys those goods and services in the country's currency that is exporting, and that increases the demand for that currency. All other factors being equal, it causes the currency to go up. And a strong dollar, as that currency goes up, it allows the holders of dollars to have more buying power. So it is something that these trade balances are very important. So for example, if we went to 2021, the US traded 5.9 trillion with other countries. But of that trade, if you broke it down, 2.5 trillion was exports and 3.4 trillion was imports. So that means that there was a huge difference, a huge trade imbalance, and it's something that is not a good thing overall. Of course, printing lots of money. Zimbabwe is my favorite example. They can once they get the printing going, you can see how they were trying to basically just create money out of thin air, and they were able to create money out of thin air. And here it takes 100 billion Zimbabwean dollars to buy 3 eggs. So what about why does an increase in the interest rate make a currency appreciate? Here's a chart that shows this. So this is showing US dollars and Mexican pesos. There's an initial exchange rate where a certain number of US dollars buys 10 pesos. So about 8.5 US dollars buys 10 pesos in this graphic. And then if the quantity of pesos traded for US dollars, if we look at that, you can see the impact there. So basically, all of these things come into play in being able to predict the exchange rate. Another thing that's relevant is recession. Why, if a country is going through a recession, would you expect that to weaken the currency? Well, there's several factors, but one factor that always comes up is when countries get into a recession, the governments of those countries, they love to try to stimulate the economy to try to get it out of a recession, because that's something that the politicians want, because that creates jobs and it makes it easier for them to get reelected. So they want to stimulate the economy, and they often will do this by trying to get the interest rates lower. So lowering the interest rate is what they want to do in a recession. And when the interest rate is lower, the demand for that currency relative to another currency also becomes lower, because if you could get a higher rate of interest in another currency, you might be tempted to buy that other currency and earn higher interest rates. But if the country's lowering the interest rate, it decreases the demand for the currency. So these things are all tied together, how they work. Lots of examples here. This is an interesting chart that shows the US dollar, Ukrainian hryvnia, and you can see here quite a movement. And this is when the National Bank of Ukraine, they actually set the official exchange rate where they artificially set it. So it's kind of interesting. A term that you may hear in currency trading is a point. This is an important thing to know. A point or a pip is the fourth unit after the decimal point. So for example, in this 1.3001, the 1 is a point or a pip, and then the spread is the difference in terms of the smaller the spread, the more liquid the currency. So if you have a pair like euro, US dollar, this is very liquid. It's going to have a very tight spread. But if you have a pair like, say, maybe Ukrainian hryvnia and Zimbabwean dollar, this is not going to have as tight a spread because it's less liquid. So it's just important. A lot of currency traders, the mistake they use is, especially if they're new and they don't know what they're doing, is they love to use high leverage because they figure, well, you know, I've got a small amount of money, and if I lose it all, I lose it all, but maybe I'll get lucky and I'll win. It's exactly the same thing as a gambler mentality, but it's not a good way to trade currency. Couple of reminders for the group. Please take the time to fill out the sign-in sheet, and it's a good idea to include your contact information. And if you have any friends or colleagues that you think would benefit from these meetings, you are welcome to invite them. Come one, come all, everyone's welcome. And then, of course, I also am available for mentoring if you're a new investor, or maybe you're an experienced investor and you think you already know everything. You still should talk to me. I might be able to show you some things you haven't seen before. And I am available to mentor and to help people. Just reach out to me if you see this on the internet. All right, so that is it for our presentation. I'm going to go ahead and stop the recording, and now I'll open it up for any questions if anyone has any questions.